To give you a perspective of what that means, and I don't want to draw a straight line here, but Venezuela, when they defaulted, was at 138%. So to me, I personally feel that the US is a growing concern. And not even so much about the now, it's the opportunities that it has presented for other countries around the world. When you have a low GDP to debt ratio, you have the capacity, the fiscal ability to be able to borrow. And that borrowing goes towards infrastructure, goes towards the spur of the economy. It goes towards also maybe addressing any emergencies that you have. COVID was a perfect example of that, where they had to borrow in order to make sure that people had enough money to buy groceries. And I get that. And used responsibly, it can be a very effective tool to encourage and kickstart your economy. But they're running out of room. And similar to a credit line or a credit card that you have, there is a limit. And once you reach that limit, then you don't have the capacity to borrow anymore. Other countries have better, I would say, numbers when it comes to their debt to GDP ratio. To start with, amongst their G7 nations, we've got France, which is at 118%. Keep in mind again, US is at 128 as we speak right now. Canada is at 118% GDP to ratio. They have the capacity to borrow, to kickstart their economy, to invest in infrastructure, to get jobs, or create an opportunity for jobs. China, which is arguably the thorn on the side for the USA, is only at 102% debt to GDP ratio. Whereas, in the earlier discussion, India was highlighted. India is in a very, I would say, sweet spot at the moment because they've got great GDP, high GDP at 6%, but their debt to I'm losing my train of thought here. Their debt to income ratio at this point in time is only at 78%, and Germany, steadfast, very fiscally responsible, is at 66%. The gold standard, Australia. And I understand, Australia is not necessarily known for being, a major player from a GDP perspective, but they have the capacity because their debt to GDP ratio is only at 42%. In my opinion, I think the greatest opportunities are with these countries who have the capacity to borrow to kickstart their economy. And I think that the US is a growing concern just due to the significant level of debt that they have.
Geez, tell me what you really think, right? Now, I think for a lot of people, we're talking about debt, we're talking about deficit, right? What does these things actually mean? So countries like the US, right, when we're looking at deficit, year after year, they have income that comes in, right, through forms of tax revenue, through investments, but they also have expenses, like all other countries, social security, healthcare, innovation, the military, so on and so forth. Now, the deficit is actually the difference between these two things. And year after year, as that accumulates, that is what the debt is. Now, if a country is, obviously spending more than it earns, it's going to have a deficit. And all the nations that you've just, clearly stated, they also all have debt and they have deficits. But to break it down, right, 25 to 30% of this debt in the US is owned by foreign countries. Like Maurice evaded to it also, where he was talking about the safest instruments out there. These are US treasuries. But nearly 75% of US debt is actually owned by the US itself. That comes in the form of US pension funds, US, the US Fed, US banks, US institutions, US families, US individuals. The whole point of this is an internal wealth transfer. Right? This isn't money that's being lost. It's money that's being circulated. It's money that's going towards innovation. It's money that's going towards infrastructure. Right? Think about something like infrastructure. Right? Infrastructure projects like highways, like dams. These things are employing workers. This in turn improves the economy, improves the environment that American workers are in. Another thing is tech, right? Innovation. A lot of the money is also going towards these large technology projects. Right? These in turn also employs workers and has a sort of multiplier effect on the economy and then in turn the stock market itself. And I think a reasonable amount of debt is fine, but the key thing about the US and its debt burden is that it has a plan to actually tackle this, right? Eamon, you talked about the One Big Beautiful Bill Act, OBBBA, a lot of B's in that. And Scott Bessent, the Treasury Secretary, he has a plan, right? There's a plan to tackle that debt through economic means. It's not actually, we're just going to issue a lot of debt to then spend on, aimless things. The whole point is to use that debt to tackle, to tackle the debt through economic means itself. And I think another key thing to consider is, what is the debt that we're talking about, or what are the underlying instruments, right? This is US Treasuries. This is US debt instruments, right? T-bills, notes. And this is extremely important for the global economy. We need US debt in the market. Let's assume, a business, let's say Warren Buffett, he wanted to park $80 billion in cash. He doesn't leave it in cash, he leaves it in US Treasury bills. That's because the US Treasury bill is seen as the gold standard. It is what the risk-free rate is based on. It is the safest instrument out there. Every other debt instrument is based off of that, right? So the US has never actually missed any interest payments, right, on their debt itself, right? The interest payments are a factor of the debt burden, but they don't miss any interest payments. And you talked about a few different countries, right? You talked about Canada, France, Australia was one of those, countries with lower debt to GDP ratios. But the reality is they don't have, a booming stock market. They don't necessarily have, a booming economy either. And the whole aim of the game for this is, right, what are we identifying as potential investment opportunities that have been and that might continue to be? Countries like Japan, they have an even higher debt to GDP ratio, significantly more, around 200% in comparison to the US. So I don't think that high debt or low debt is going to define a country's stock market or its economy purely. It depends on what the actions are to tackle that and how they're utilizing it. And each country is not the same, right? The US has a purpose to have that debt out there. But look, I think, talking a lot about debt, talking about how debt is issued, I think it's a great segue onto our next theme, right? Next theme is all about currency. So when we look at currency, right, what are we talking about? This is the US dollar acting as the world's reserve currency. Now, whilst the US issues USD, right, I really believe that this is a strong argument as to why the market will be, the US market will be a beneficial place to bet on as a result of the large currency reserves that are out there. Maurice talked about Ray Dalio, talked about the New World Order, the sort of shifting times. And what he's sort of referring to is, historically, we've always had nation states that have been in place, right? We've gone through states where it was the Dutch, the French, the British. Now that is the US, right? In 1944, the Bretton Woods Agreement was agreed upon. It ultimately said that we're going to ditch the gold standard and we're going to put the US dollar as the global reserve currency. Like, fast forward almost a century, right? We're over 80 years from there. The US dollar is still the global reserve currency. It's still the strongest currency out there. And I assume that everybody in this room, right, is investing in US capital markets in some form, some shape, whether it's US stocks, whether it's bonds, a lot of other instruments out there. But the reality is the US has the most liquid, the largest, the deepest capital markets out there. Right? It needs to be that reserve currency, because the reality is there's no other competitor out there that can challenge them on this level. Right? That's in just, in equity markets. If we look at it from debt markets, treasuries, notes, T-bills, all of these things are issued in US dollars. So the pure circulation of US dollars is so significant. Right? And there's a lot of narratives right now about divestment, right? A lot of countries are, they're moving money away from the dollar. And I think that's more political statements and narratives that are being made. Because when you actually look at the numbers, right, approximately $9.4 trillion is held in US treasuries, right? And that's by foreign investors. That's an all-time high. There's a lot of data that suggests that China is actually pulling back US treasuries. They're not actually investing in them as much. The reality is that they still are, just in offshore custodian accounts. So there's still a lot of money that's actually being circulated in US dollars. Now, what about trade, right? A lot of people talk about trade and what the impact of trade is, and will different arrangements change where people will start embracing other currencies for trade. Once again, let's look at the numbers. Reality is the dollar accounts for 88% of global foreign currency, right? 70% of foreign currency debt, 60% of international banking liabilities, all in USD. It's the most frequent invoicing currency, 96% in the Americas. It's 74% in Asia Pacific, 79% in the rest of the world except for Europe. And I think a really key point about this, 93% of US imports are invoiced in dollars. So even foreign countries are doing this. And I think a little bit more modern to the times is SWIFT payments. We've talked a lot about what's happening with international payments and transactions. 50% of all payments are done in US dollars. Projections are for that to go to 60% in the next couple of years. So the reality is it's actually just going up, and that trajectory is actually increasing. I know the narratives are changing, but the trajectory is actually, and the numbers show that it is increasing. But this is all to say these are the positives, right? What are the alternatives? Realistically, what are the alternatives? I have been hearing about de-dollarization for the longest time. This conversation has been being had for the last 30 to 50 years. It's like the boy who cried wolf, right? De-dollarization, de-dollarization. Could it be the euro? It's the second largest currency in the world. The reality is, it's just 20% of global reserves. The USD is 58% of global reserves. Could it be the yuan? 3% of global reserves is the yuan. Like, a lot of people talk about the petro-yuan trade and this potential. The reality is the scale and the liquidity is just not there. And the last one is the BRICS, right? A lot of people have been talking about the BRICS nations recently. The BRICS nations have been talking about forming a currency. I just think the reality is those are nations that are more rivals as opposed to allies who are, ultimately trying to dethrone some of the other markets out there. And I just don't see it happening realistically. I feel like with the BRICS nations, they're more likely, I don't think they're even able to figure out what time to go for lunch as opposed to, form this brand new currency that's going to dethrone the dollar. So that's just where I'm at with it.
Love that. And I picked up on you said narrative, and a lot of people kind of associate the trust in the US dollar as just all narrative, but you completely ignore the background and the structure that reinforced the US dollar being the reserve currency. And you've mentioned it, actually. You've touched on it, and you very conveniently moved away from it. But the Bretton Woods Agreement was essentially the architect to consider the US to be the reserve currency of the world. But there was a requirement to be backed by gold, to which the US moved away from the gold standard in the 70s, and very conveniently and very quickly essentially went into an informal agreement with Saudi Arabia to ensure that they priced their oil in US dollar. And essentially what they've done is created a structural floor for the demand of US dollar. They have reinforced it where it's not just sentiment, it's not about market, I would say demand and supply, but there's a structural floor to that demand, which was the baseline as to what allowed that currency to strengthen. That informal agreement with Saudi Arabia ended in June 2024. Now, it's no longer is there any exclusivity. Saudi and other GCC nations are permitted to be able to sell oil in a variety of different currencies and different types of arrangements. So what that's done is it's forced the US dollar to actually compete on its own metrics. It is competing for other, with other currencies across the world. And where we stand today, as of February 2026, we now see 20% of the world's oil is being traded in currencies outside of the US dollars. So there is an impact. It may be small, but it is building. And I do want to add, it's just a small little thing, throw it in there. Have you heard of renewable energies? Oil reliance is not a thing anymore. There is a lot more renewable energy industry, which further puts pressure on the whole petrodollar arrangement altogether, because I've got solar panels on my house. So, hey, Second thing, when we talk about trust and the narrative about trust, much more as of late, and I would say probably the post 9/11 era, is that the U.S. has chosen to use the U.S. dollar in a form, in a weaponized manner. Sanctions just roll off the tongue, and considering the fact, yes, the majority of the world is operating in U.S. currency, it's as simple as shutting off the tap very quickly through digital keys. Now all of a sudden you're not able to trade or able to conduct business in dollar anymore. This is leaving a sour taste with many of its allies and also non-aligned countries as well too, where that trust in the US dollar is now becoming a geopolitical risk in holding that currency itself. We saw a big example of that, again, right or wrong. We saw $300 billion of Russian assets, the reserves that they had, essentially frozen just due to Washington's policy at that point in time. So countries do take notice of the fact that they have this much of a hegemony, that the fact that they control the SWIFT systems. So there are countries who paid attention, and now they've started developing other mediums, such as mBRICS, or trying to remember the name exactly. Yeah, BRICS Pay, so looking at mBridge. These are other mediums, essentially, in which you can now, conduct trade and transfer money. So this is leaving a sour taste in individuals' minds, and it's giving people a reason to consider holding assets in other currencies altogether. But if I have to kind of pick the biggest growing concern, and I have to kind of use an example here, actually, to kind of highlight the depth of this. And I don't mean to go back to the whole debt and deficit, but this is a significant part of the concern. Whereas if you were a lender, you were a bank, and you're lending to an individual, and you see this individual is, pays regularly, quite stable job, income is, the ratios are great, you're likely going to give this person a favorable interest rate on the loan that you're extending. But assuming that this person over time starts going through financial hardship, they start missing payments, and I'm not saying the U.S. is missing payments at this point in time, but there's signs that this is going to catch up to them. As a lender, you'd be concerned. And being concerned also means that I need to kind of hedge my bets. I need to ensure that I price effectively the risk that I'm taking, and I'm likely going to increase the interest rate on this individual. Probably terrible for that individual themselves, but for the bank, it's a risk assessment, really, for them at the end of the day. So instead of charging you 4%, I'm going to charge you 6%. This looks to be, in my opinion, the outcome for the US, where over time that debt, that interest that they're paying on is going to accumulate and accumulate. It's going to get to the point that it's going to be difficult for them to service. And that means then all the lenders across the world, those who are buying US treasuries, are going to demand a risk premium. No longer are they going to be happy with the 4%. They want 6%, 7%. Now you are, for all intents and purposes, at risk. We've seen the recent downgrade, by Moody's on the U.S. Financial health. So my point being is that this is very counterproductive to the U.S. This is actually against, because if interest rates rise, that just means that they go further into that vicious debt cycle, and inevitably, all roads will lead to the same thing, which is bankruptcy. So in my opinion, I think the US dollar currency has significant concerns or significant negative tailwinds going forward. But I'm tired of talking about interest rates, and deficits and whatnot. Let's talk about real things like bricks and mortar. Let's talk about things that America has made a primary focus for themselves, which is essentially manufacturing. That was, for this administration, that was a big, I would say, pillar of their administration, in which they wanted to bring manufacturing back to the U.S. The idea and the concept of globalization for them is a zero-sum game, and they're not benefiting from it at this point in time. So they've taken a very isolationist approach to manufacturing. The problem was that the execution, the idea is brilliant, but the execution of which has been very disastrous for the American people. This has arguably been one of the largest national tax increase in percentage of GDP terms for Americans, and especially for those who are in the lower income bracket, even up until the blue-collar segment of the U.S. This has essentially taken upwards of $1,300 out of their purchasing power every single year. And you have to understand, for this demographic, they tend to spend a higher percentage of their income relative to wealthier individuals on basic consumer staples. We're talking about, clothing, we're talking about food, we're talking about furniture, et cetera, et cetera. So this $1,300 is very meaningful for these individuals, especially those who live within the poverty line or just below, in this and the blue collar level itself. So that's a significant impact. We've seen manufacturing contract ever since the announcement of the tariffs in April of last year. To the point, actually, we've seen that the employment numbers have shown that 72,000 jobs, net loss of 72,000 jobs within the manufacturing space itself. There's a lot more empty shelves just because large manufacturers cannot afford to invest in just-in-time inventory. And as a result, you're seeing a lot more empty shelves. But the biggest concern, and I would say the biggest impact to this, is that America thought that they're going to make everyone bend at the knee to their will. But in reality, what's happened is that trade has started to be rerouted to other parts of the world. Whereas America is building, I would say trade barriers, but the rest of the world is building bridges, really, at this point in time. And case in point is this mega deal between India and Europe, just announced not too long ago, considered to be the mother of all deals, where they're going to get access to 25% of the global GDP through this trade union with EU and India. And, it's not even just about the opportunity itself, but you don't realize what this means for 50 years to come, because essentially India is now going to be a very big trading partner with Europe. And what that essentially means is that they need to manufacture to the certain level of standards that Europeans expect, whether it be from a regulatory perspective, product perspective, whatnot. This means that this is going to be a significant investment in factories, in knowledge capital, that is going to be permanent. This just doesn't go away, that all of a sudden, okay, we've learned exactly what your standards are, et cetera, et cetera. It builds from here. 20, 30 years ago, we used to think that if it said on the label, made in China, that you thought, okay, cost effective, but probably not gonna last that long. How many Chinese vehicles do you see on the road today? China has done a lot to improve on their quality, and I foresee the same thing for India as well, too, that they're going to be a force to reckon with many years from now. China, they thought, would be essentially, blocked out from trade from the US, and as a result, it's going to hurt them. China doubled down and started working with their ASEAN country partners. And in fact, their exports didn't diminish. It actually flourished ever since the tariff announcement. So the idea is that these tariffs aren't working. They're actually hurting the country more than anything else. It's expected that the spending or investment in manufacturing is going to reduce by $490 billion by 2029. So I think the writing's on the wall, to be honest with you. But I imagine you probably have a differing opinion.
Yeah, look, fair enough. Look, and I think the points that you just made actually echo a lot of them, but just on the complete other side, to be completely honest. So we talked about investment, right? You're talking about investment in other countries, and they're starting to form these new trade alliances and stuff. But the reality is there's been a huge investment surge in the US in 2025, right? $3 trillion was, committed to actually put back into reshoring activities, reindustrialization activities. All of these things create jobs, right? In 2024 alone, they announced that there was going to be 244,000 US jobs that are going to be created. Jobs that were previously being outsourced. A lot of these are manufacturing jobs themselves, right? Historically, the US has relied a lot on foreign direct investment. Significant amounts, right? You talked about it. Other countries is where they, import their goods and services from, and that attitude has kind of changed as a result of some of the new policies that have been put in place. But with that now, the actual US commitment to, and the investment surge that they've committed to US jobs and manufacturing is now outpacing foreign direct investment. So there is a significant amount of capital that's being committed to the US. And who does that benefit, right? That benefits US workers, once again, those economies, but in turn, the stock market, right? And that is why when you look at these US companies and the performance of them in comparison to the globals, there isn't really much of a comparison because they're so significantly ahead of the curve when it comes to that. Now, some examples of what are some of these companies that are actually doing this. Do you guys remember the Sharpie marker? Newell, they're a company that actually just said that they're going to put all of that production back in the US. Amarok, who produces chips, AI chips, they said that they're going to actually they actually already started chip facilities in Arizona, right? Hyundai.
When's the last time someone used a Sharpie? Like, who cares?
$7 billion worth of that is what's being committed back. So it's not small numbers. Now, the other thing is Hyundai. They've committed, around $4.2 billion in US steel production. So these are significant amounts of investment that are going either back to the US for their manufacturing, and then not only that, those other countries are also not losing out on some of that business because they don't actually need it anymore. Once again, right, going back to that isolationary rhetoric, the sort of narrative around everything, the US is still a magnet for global capital. $4.2 trillion in investments that have been planned. Right, think about it like last time the president was over here. He met with the CEO of DMAC, and the next thing you know, they have pledged billions and trillions of dollars towards data centers in the US. It goes to different countries, it accumulates foreign direct investment, and whether you agree with it or not, the outcome is more positive reinforcement for the US, its strength in its currency and the strength in its markets also. So there's a big sort of change in that. Now, you talked about isolationary policies, but I think, I almost think the opposite of that, right? Where the US is actually going towards more of an economic independence. I don't think they necessarily are relying on other markets. I think the reality is global markets need the US. I don't think that the US needs global markets. And in the end of the day, it actually improves their position, right? They're not actually reliable on adversaries that they had before for, any trade deals or anything else. And I think whilst this has also been going on, there's been a huge productivity boom, right? US workers' productivity surged to 4.9% last quarter. This is a lot more than what it's been before. So the actual reshoring, the reindustrialization is all working. And I think, you also mentioned about tariffs, right? And whether you agree with them or not, and Maurice also talked about this, it's more of a bargaining chip of what's actually happening, right? This is where it starts, and this is actually where it ends. The tariffs are historically not actually proving to come to fruition. And you actually see, and I think people are almost probably giving the president too much credit for this, but the reality is every time that the markets shake is when the tariffs usually get cooled down. You see a stock market plunge, they kind of, okay, look, this hasn't worked out well, so let's actually, work back on the tariff. So I think it's more of a bargaining chip as opposed to anything else. But, we're looking at, manufacturing, and we talked a little bit about AI and what this means. But, the next big thing, and what I really believe is a huge reason as to why, the US is so dominant in the market, and especially for investors, is technology and AI, right? I think everybody here has a pin. I assume that every single one of those pins is a US equity company, right? Any other
tech
ones?
company?
Any non-US tech companies on those pins? And that wasn't planned, by the way, right? Now, everybody in the audience here, right, I want you to put your hands up, and I want you to keep your hands up if what I say resonates. So, who this past week has used ChatGPT? Who has used Google Gemini? You keep your hand up. Who has used Claude? Who has used Grok? So if you've used all of those, put your hand up. Or if you've used any of those, just put your hand up. Everybody. Okay, now everybody hands down. Who has used DeepSeek in the last week? I rest my case. Should we stop this? Or
We're friends.
I saw like
it's
3
okay.
people.
I don't need that many. We're friends. It's okay. You're on my team.
Eamon, have you used DeepSeek this last week?
No comment.
Okay, so why is that the case, right? One of the biggest things is capital expenditure, CapEx, right? The US is investing historic amounts in capital investment into these hyperscaler companies. Microsoft, Alphabet, NVIDIA, they're investing, the projection is 500 billion by the end of this year. That's up from 150 billion 2 years ago. So the scale and the sheer mass and the exponential growth of investment is significant, right? They've committed $2.1 trillion to investment capital to build out data centers. In Europe, the opposing amount of that is $200 billion. So there's a huge, significant difference in what's actually happening. And ultimately, what this means is there's a significant impact in this AI investment that GDP growth is significantly, it's once again growing exponentially. And this is just one of those things, right? AI is one tiny component of these mega cap companies, right? This is not their main business line. Their tiny component is so much more significantly larger than the rest of the developed markets and the emerging markets. Now, a lot of people like to compare, the current economic environment with, AI and tech with the 2000s dot-com bubble. Right? So what is the actual difference between those two times? So during the 2000s, any company that had the word internet in it, stock was flying. But when you actually looked under the balance sheets, you looked at the financials, they were, very, very poor. What ended up happening was a bubble, these companies crashed. When you look at AI and these companies at the moment, they've been soaring, but the actual underlying fundamentals are solid. Very, very low debt, significant cash flow, huge spending capabilities, and they're using it. So that's why we've seen such a significant economic growth. And when I look at what are the other options, right? What are the other opportunities that people could look at? If you want to look at technology or AI in Europe, I think the reality is regulation is so severe that these companies haven't been able to develop. I think European markets are a lot more focused on pharmaceuticals. They're much more focused on automobiles. But in terms of tech and AI, they can't compete. And I think with China, look, to be fair, China and some of the other emerging market countries have done, they made significant progress, in this tech race and in the AI race. But the reality is, I think with the amount of, the sort of lack of transparency and, more often than not, the ability to actually produce these products for the global scale has just not been the case. Now, in China, for example, the government is not even allowing private companies to use these AI models in certain cases. So, if that's the sort of environment that is going to be there, I just don't see those countries being able to keep up with the US and definitely not, outshine them, because with this growth, it's so significant. And not to say to predict, hey, is this going to continue forever? But the reality is it's been, so significant over the past decade that it's, there's a reason why Apple's market cap, $4 trillion. Do you know what the FTSE 100 combined is? $3 trillion. One company's market cap is larger than the whole of the largest 100 US or UK companies. So it's not even a comparison.
Like I'm not denying the AI innovation. I am not denying that AI is going to be part and parcel of our day-to-day lives. I do not deny the fact that it's a revolutionary technology. But to your point about other countries not being able to keep up, they won't need to, because you're going to crash and burn. And why you're going to crash and burn is simply because the primary reason being is the circular financing, I would say, ecosystem that all of a sudden somebody thought was a brilliant idea. And kind of reminds me of that Spider-Man meme where they're just kind of pointing at each other like this all the time. Where, to give perspective for anyone who doesn't know what the circular financing, it's something that's been happening between OpenAI, Microsoft, NVIDIA, Oracle, where essentially they're investing in each other in exchange for purchasing goods and services. And it's like the equivalent of, let's just say you were an artisan, you were an amazing baker, right? You make amazing breads altogether. And you want to open up your own bakery, but you don't have the money to do it. So you come to me, a very wealthy, let's just say, landlord who owns a lot of ovens that I could rent out, and you say, look, I've got this idea of this beautiful bakery. Can I please rent some ovens from you, but I don't have any money? I take a keen interest in you. I believe in you, and I say, look, don't worry about the money. I will invest in you, and I'll give you $10 million. But condition is you have to spend that $10 million on renting these ovens from me. From a revenue generation perspective, I am booking $10 million in rentals. I have made, on paper, $10 million. But in reality, I'm not actually going to be getting any liquidity or capital back. I'm just going to be taking equity in your business at that point in time. That is a single point of failure. Now multiply this by 3, 4, 5 companies who are kind of just doing this in circles altogether. This is where the danger lies with regards to the way that the AI industry is operated within the US. And it's understandable because this speaks a lot to the, I would say, the American mantra of bigger is better. But they were quite embarrassed last year when DeepSeek, it was last year, DeepSeek version 3 came out, and it was found that it was able to, if not the same, just almost the same level of operational efficiency and excellence, but it was a fraction of the cost to put together, whereas it cost DeepSeek $5.4 million to get up to speed, whereas it cost OpenAI $3 billion. This is where the opportunity lies for other AI challengers, essentially to start offering, I would say, their services at a much more reasonable price point. Because at the end of the day, if OpenAI and if Microsoft and all these entities are going to be spending billions of dollars, and apparently it's going to be reaching $1.3 trillion in accumulated investment, there needs to be a return on investment. How are they going to do that? $20 a month is not going to address that, and they still have not figured out their monetization process altogether. Well, organizations like DeepSeek out of China, they don't have the same financial pressures because good enough is good enough. What good does it do for you if you have a car that has 2,000 horsepower, that can, give you, massages while you drive, it could probably cook a meal for you while you're sitting there in the passenger seat? What good is that when sometimes, look, I just need a car to get me from point A to point B in a very safe and stylish manner, and I'm okay with that. And I think that's where industries are mostly going to go to.
That car sounds pretty good. I'll take it.
I am kind of hungry, actually, come to think about it.
Fix my own meals.
The last point I wanted to make just on this AI thing is that these ambitions, they're far greater than your capacity to deliver to them. And I say you, I know you're not America, but I have to point at something. They're far greater than the capacity you have to deliver because America does not even have the infrastructure, the energy grid to be able to deliver on the level of investment and expectations in the AI industry. China has been steadily building for the last 20 years infrastructure, not even knowing about AI, but just preparing themselves for the future. And they're well positioned to be able to leapfrog America, to be able to essentially, facilitate the required gigawatts of energy to be able to facilitate the needs of US. It takes 5 to 7 years for a plant essentially to get, up and running. China's already well ahead, and they have enough capacity as of today to be able to power half of the US. So on that point, I would say I think there's greater challenges ahead for the U.S. in this respect. I want to kind of bring it home. I think, and this one is self-explanatory. I mean, we've been talking about it from a macro perspective. We talked about it from AI, technology, et cetera. But at the end of the day, look, the consumer sentiment matters because at the end of the day, the increase in cost of living for these individuals. So groceries cost more, eggs cost more, you name it, cost significantly more. But that's an experience for those who are more impoverished, people who are in the lower income aspect of this. That's a significant impact to them. However, for those who are very wealthy, and of which, by the way, just to let you know, the top 10% of American households currently own approximately 80% of all individual stocks. So what you're seeing is that you have the uber wealthy, and you have elite uber wealthy, and you have a large base of individuals who are just trying to get by, which essentially is resulting in a K-shaped economy, where you see the stock market continuously going up, but you're seeing sentiment continuously go down. This can't last forever. At some point in time, the chicken has to come home to roost. And I will finish up at this point. I think you're probably tired of hearing me, and I think the audience as well too. Why don't we take a break? I'm going to share just a final story, and it was something that I actually had heard from Andrew Hallam many, many years ago, and it really kind of stuck with me to kind of identify the relationship between a business, the economy, and the stock market itself. And it was a very beautiful story that he told, and I hope I'm going to do it justice in itself. But he gave a story of an idea of a gentleman walking his dog, and the dog is on a leash. The leash has some slack. And so from time to time, while the owner is walking the dog will dart forward, will dart backwards. Sometimes it'll stay still. Sometimes it'll go left. It'll go right. But always tethered to the owner itself and always comes back. This was a perfect analogy for the economy and the stock market. The owner is the economy. The stock market is the dog. It may jump around, go back and forth, whatever, but at the end of the day, it is a reversion to the mean. There is always a reality check at a certain point in time. And I thought that was a really great way to highlight what the consumer sentiment is at the moment, the risks and challenges ahead of them, and I'll leave it off on that. Over to you.
Thank you. Yeah, look, I think that story it's a really good one because it's an analogy, but I don't think it's unique to the US itself. It's unique to global stock markets. You talk about consumer sentiment in the US and what that wage disparity is and what that income disparity is. The reality is it's a global thing. It's not something that's just in the US itself. And I'm going to keep this quick, right? Because once again, to bring back the point, whilst consumer sentiment in the US is the sentiment, right? At the end of the day, it's not hard and sort of hardcore numbers, but there's thrivers, right? These are 40%, right, that you alluded to. They control and they're responsible for 60% of that wealth and that growth. And that has continued to grow. But when you actually look at consumer spending, right, not just sentiment, consumers in the US are spending like at record levels. This holiday season was, it blew away all of the expectations in terms of what consumer spending was going to be like. The reality is people might feel a pinch, but consumers are continuing to spend. What does that mean? They're spending in US businesses. That in turn results in a very strong US stock market. Once again, don't need to drive the point home, but the reality is people are spending money. The sentiment might be slightly different, but the sentiment is different everywhere else. And that money that they're spending is what's actually fueling the economy.
Feel like we're not really going to agree. And I really hate, and I hate this whole let's agree to disagree. Yeah. I feel like we need a third party to kind of, be the tiebreaker. Or we can
hang out here for another 2 hours, talk about it some more.
I'm tired of listening to us. I do want to invite someone to the stage. Brandy, presenter on the Business Breakfast, Dubai Eye 103.8. We'd love to see if there's anything that we can clarify in hopes of you deciding in my favor. I'm just going to grab another chair.